All right, today we're digging into a really interesting one, Service Properties Trust, or SVC. Now, this is the company that's right in the middle of a massive, high-stakes overhaul. You could almost say they're hitting a giant reset button on their whole business model. So let's jump in and see what they're up to.
And it all really starts with this one big question. I mean, why would you do something so drastic? Selling off a huge chunk of your properties and then basically tripling your number of shares. Well, that's not a casual Tuesday afternoon decision. These are the kinds of moves that make investors like us sit up and go, whoa, what is going on here? It's a huge signal that something fundamental had to change, and it had to change fast.
So, to really get why they made these moves, you first have to understand the hole they were in. SVC was on a path that just wasn't sustainable, and believe me, the numbers tell the whole story.
Okay, now look at these numbers, because this is where it gets pretty ugly. A negative net margin of over 11%? That just means the company was losing money hand over fist. And a negative return on equity of almost 30%? That's a massive red flag for anyone putting their money in. But the real kicker, the elephant in the room, was the debt. Over $5 billion. That's the kind of pressure that forces a company to do something radical.
You see, the root of the problem wasn't just the debt. It was that the company basically had a split personality. It was running two completely different kinds of businesses under one roof, and one of them was dragging the other one straight down. This created this fundamental tug of war inside their own portfolio.
So, to get the stable side of the business, we need to know what a net lease is. And honestly, it's pretty much a landlord's dream. Imagine you lease out a building and your tenant pays for almost everything. The taxes, the insurance, the upkeep. For SVC, this means a super steady, predictable stream of cash. It's the bedrock of their income, just money showing up in the mailbox every month.
And this slide just lays out the whole conflict perfectly. On one side, you have the hotel business. It's volatile, it costs a ton of money to keep the properties fresh, and you've got huge labor costs. Then on the other side, you have those beautiful net lease properties, stable, long-term, and super low maintenance for SVC. It's a classic battle, right? High-risk, expensive assets versus low-risk, steady income ones. The problem was, the risk from the hotels was just drowning out all the stability from the net leases.
So, management looked at this mess and came up with a really decisive plan. The goal was simple: pivot hard towards stability and run away from all that volatility. And here's exactly how they started doing it.
The first big move was a massive sale. In 2025, SVC sold off 112 of its hotels that just weren't pulling their weight, and that brought in nearly $860 million in gross proceeds. Now, this wasn't just about grabbing cash. It was like a strategic amputation. They were cutting off the parts of the business that were draining all the resources to make the whole thing healthier.
And that cash, it got put to work immediately. Now, as an investor, this is exactly what you want to see. They took the money from the hotel sales, added some cash they had on hand, and paid down a staggering $1.1 billion in debt. This was a direct assault on the single biggest threat to their financial future.
And this right here, this is the end goal, a complete transformation of where their money comes from. The plan is to go from a 50-50 split to a future where a huge 70% of their earnings comes from that stable, predictable net lease portfolio. This is the new investment story for the company.
But just selling off assets and paying down some of the debt, well, that wasn't quite enough to secure the company's future. They had to make another, even more painful move, one that hits shareholders right where it hurts.
You know, this quote from an analyst report just sums it up perfectly. This wasn't a simple little cleanup, it was high-stakes financial engineering. It was designed for long-term survival, even if it meant some serious short-term pain.
And that pain came in the form of shareholder dilution. Think of the company as the pizza. If you suddenly issue a ton of new shares, you're just cutting that same pizza into way more slices. So your personal slice gets smaller. For investors who are already in, that's a tough pill to swallow. But from the company's point of view, a smaller slice of a much healthier company is way better than a big slice of a company that's about to go under.
And here's exactly how they did it. Step 1, raise over $500 million by issuing a boatload of new shares. Step 2, and this is the crucial part, they immediately took that capital and used it to attack their high-interest debt. And Step 3, they targeted another $500 million in debt that was coming due in 2027. It's a clear, surgical plan to take out the most immediate threats. So, with the company's finances...
Thanks for watching. If you enjoyed this video and want to see more investing content, tap that like button and make sure you subscribe to the channel.
So, with the company's finances much more stable, what does the road ahead actually look like? Well, if you're looking at SVC today, you've got to weigh the potential good stuff, the catalysts, against some pretty significant risks that are still lingering. Okay, let's start with the bull case. The hotels SVC decided to keep have been heavily renovated, and they're starting to steal market share. Plus, huge events in 2026, like the FIFA World Cup, could give them a major boost. Over 40% of their remaining hotel rooms are in host cities. On top of that, with the big spending behind them, their cash flow should improve, and they're set to save around $14 million a year just in interest payments. But you have to weigh that against the risks, and they are real. They still have a lot of debt coming due in 2027 and 2028. The hotel business, even the smaller version, is still super sensitive to any kind of economic slowdown. Those high labor costs haven't vanished, and they continue to squeeze profits. And even on the safe net lease side, a few of their tenants are showing some signs of stress, which is definitely something to keep an eye on.
And that brings us to the final, multi-billion-dollar question. Was this whole thing a strategic masterstroke that saved the company and set it up for a stable, profitable future? Or was it just a series of incredibly risky bets that bought them some time, leaving their fate tied to a shaky hotel market? The board has been reset, for sure, but the game is far from over.